What if the US housing market isn't just slowing down, but entering its most significant correction in more than a decade? The US housing market is entering its most significant correction since 2012, as new data from Zillow and Realtor.com shows a slow-moving but increasingly broad downturn that contradicts years of optimistic industry messaging and signals a decisive shift in the long-overheated real estate cycle. Zillow now reports that 53% of American homes have lost value over the past year, the highest share in more than a decade, with the steepest declines unfolding in the very markets that inflated most aggressively during the pandemic. In Florida, Texas, and Northern California, more than 90% of homes have seen their estimate fall, and once frothy metros like Cape Coral and segments of the Bay Area are now posting price cuts that bring mid-tier homes below $300,000 or tens of thousands of dollars beneath their peak valuations. Yet even with these localized drops, the national picture remains historically extreme, with inflation-adjusted U.S. home prices still more than 80% above their 100-year average, a reminder that this correction, while spreading, is only beginning to reverse years of unsustainable appreciation. The National Association of Realtors continues to issue optimistic forecasts, including a projected double-digit rebound in sales and a 4% national price gain in 2026, but its outlook stands at odds with the data, echoing the misplaced reassurances it issued in 2006 and 2007 as the last major housing cycle was quietly deteriorating beneath the surface. Today's fundamentals tell a very different story. Nationwide home values are flat overall, single-family prices are up a negligible 0.2%, condo values are down 1.5%, Florida's condo market has posted a staggering 9.9% drop, the steepest since 2009, and single-family values across much of the Sun Belt, including Georgia, the Carolinas, Tennessee, Arizona, Nevada, California, and Texas, are now trending decisively downward. The force driving this shift is swelling inventory, which has climbed to 1.1 million active listings, a 15% year-over-year jump and the highest level since 2019, while mortgage applications remain 30% below pre-pandemic norms, creating a widening mismatch between supply and demand that is pushing months of inventory sharply higher and pressuring sellers to cut prices. States such as Tennessee and Texas now have inventory that vastly exceeds long-term averages. Tennessee supply sits 50% above typical October levels, Texas is carrying more than 134,000 properties on the market, and California has reached 71,000 active listings, its highest count since 2019, even as sales fall to decade-long lows, conditions that make continued price erosion all but unavoidable. Meanwhile, the market has fractured along geographic lines. The Northeast and Midwest remain comparatively strong, with New York State posting 3.9% annual growth across single-family homes and metros like Albany, Syracuse, Buffalo, and sections of New York City still showing appreciation in both single-family and condo segments. At the opposite end of the spectrum, the Sun Belt and previously red-hot western states dominate the bottom of national performance charts, with Florida, Texas, Arizona, South Carolina, Nevada, Washington, D.C., and California all registering synchronized declines across both property types. Despite these clear trends, the correction is unfolding gradually rather than abruptly, slowed by a persistent psychological barrier among homeowners who remain reluctant to acknowledge falling values. In Austin, now considered one of the strongest buyers' markets in America, home prices are down 25% over the past 3 years. Yet only 48% of pandemic-era buyers who are selling today are listing their properties at a loss, illustrating how many sellers continue to price aspirationally even as the market moves against them. This staggered capitulation is characteristic of housing downturns, which historically unfold over multiple years rather than in sudden collapses, but analysts increasingly expect 2026 to be the inflection point when the market's inertia finally breaks. A surge of new listings is anticipated in the spring, potentially pushing U.S. inventory to a 10-year high, while demand is unlikely to rebound enough to offset the supply shock, meaning more markets will transition decisively into buyer-friendly territory with deeper price cuts, rising concessions, and broader affordability improvements. For the millions of would-be buyers who have waited through one of the most expensive and supply-constrained periods in U.S. housing history, the unfolding environment suggests that patience may finally be rewarded in the coming year, as America's overheated housing cycle cools into a prolonged, geographically uneven, but increasingly unavoidable, downturn.